This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! Hello, and welcome back to the Fintech Takes podcast. My name is Alex Johnson, and I have a very unusual podcast for you today. The plan this week was to release another edition of the popular Not Fintech Investment Advice podcast, which I do with the great Simon Taylor, author of Fintech Brain Food. Unfortunately, I was not able to record that podcast last week with Simon, entirely due to my own fault. My entire household came down with a terrible stomach bug last week, and I'll spare you the gory details, but while we're mostly recovered now, I was completely incapacitated for a large portion of last week, which meant I had to interrupt our regular podcast recording schedule. I was also forced to cancel a number of other events and meetings. I was going to be moderating a really great webinar with Cross River Bank and some friends in the fintech universe on reconciliation and subledgering, which was a topic I was really looking forward to digging into. I was also going to host the November edition of Fintech Office Hours. And if you haven't been to one of my Fintech Office Hours events yet, I would strongly encourage you to attend the next one in December. But the basic idea is that on a monthly basis, I and some other fintech nerds get together on a Zoom, and we just sort of talk through what's been happening in fintech over the last month or so. I field some questions from the audience, and we just have a nice, candid conversation. I was not able to do that during the last week because of some unforeseen illness consequences. So what I thought I would do for today's podcast is to do a podcast version of Fintech Office Hours. I have all my notes from what I was planning to talk about last week in Fintech Office Hours, recapping what's been happening over the last 2 to 4 weeks in fintech. So I thought I would just do a quick recitation of that in a solo Fintech Takes podcast. So without further ado, I'm going to dive into some of the things that have happened recently, give you my thoughts on them, and hopefully it's not too weird to listen to just one person on a podcast expand on their thoughts for a minute. So if you'll indulge me. I know that here on the show, we talk a lot about the importance of bank partnerships when it comes to the success of any type of embedded finance or fintech endeavor. So let me tell you about a provider that is raising the bar in embedded finance. Built by Fifth Third Bank, Newline enables enterprises to launch and scale payment products using their API-first platform, enabling embedded solutions that scale responsibly. Learn more about Newline by visiting newline53.com. The first thing I wanted to talk about is obviously the election. So if you live in the US or you have a vested interest in the political scene in the US, you will know that Donald Trump was reelected to be president of the United States. It was a very convincing, broad-based win, and already we are starting to see the impacts of this. I'm not going to get into the politics. I'm not a political commentator, but I do think it's worth talking a little bit about what the impacts of this change are going to mean for fintech and financial services. So I've written a little bit about this in the newsletter. There's an essay published last week that talked a little bit about the focus on deregulation as one component, but I want to talk broadly about the different pieces of what that win is going to mean and what the next 4 years might look like for fintech. So first, getting into deregulation, as you might have seen with President-elect Trump's announcement that they were forming the Department of Government Efficiency, there's going to be a strong focus on stripping a lot of inefficiency, bureaucracy, and excessive regulation out of the federal government over the next 4 years. And it's a little too early, obviously, to say exactly what that's going to look like, but the way I'm thinking about it is just a broad focus on deregulation. And we've seen this before in financial services, although it's been a little bit of time. Joe Weisenthal at Bloomberg, I think, had a really great analogy describing this. He used the Amish rite of passage Rumspringa, where Amish teenagers will take a siesta, essentially, from following any of the rules that they are normally required to follow as a part of their religion and just sort of sow their wild oats because there are no rules. That's sort of the analogy for what the next 4 years in a broad sense are going to look like. We're just going to toss a lot of the rules out the window. And as you might expect, for an environment that promises excessive deregulation. The market was very happy about this. Crypto prices are up. Stock market in general is up, and investors are very excited. I will say that I am a little worried, just in a general sense, about what a sort of return to the mania of 2021 might do to the fintech and crypto ecosystem. Obviously, in 2021 and 2020, that mania was the result of low interest rates and a zero interest rate environment where a lot of capital flooded into the market. This is going to be a little bit different in the sense that it's not going to be enthusiasm spurred by rates. It'll be enthusiasm spurred by deregulation. But I think it might have a similar effect in the market, which is it will draw in a different set of founders, and those founders will have a different set of priorities. And I'm already starting to see some very early evidence that some of those priorities, while they will undoubtedly be good for the companies and for investors, might not always necessarily prioritize the long-term interests of end customers. And, I'll pick on Robinhood as the example here. In the immediate aftermath of the election, the CEO of Robinhood was tweeting very excitedly about changes in the market and what he was seeing moving forward, and just kind of talking a little bit about the new avenues that have been opened up with prediction markets and with 24-hour equity markets and with crypto, which is now surging again, all these different opportunities to speculate on the market that are available to consumers. And again, I can totally understand from the perspective of Robinhood why that would be very exciting. But I've actually been a fan of Robinhood moving into the more boring areas of financial services over the last 4 years, things like retirement accounts and credit cards. And I'm a little bit concerned that now we're going to see Robinhood, we're going to see new companies and old companies in crypto, companies in lending, maybe focus a little less on long-term financial health and value creation for consumers, and a little bit more on indulging consumers' worse instincts as it relates to speculation, as it results to maybe taking on excessive risks. And I'm a little bit concerned about the impact that's going to have on consumers, particularly given the fact that we aren't going to have the same type of aggressive and admittedly sometimes overly aggressive regulatory apparatus opposing some of those innovations on the other side. I think for all of the concerns about overregulation over the last 4 years, and I think some of those are valid, the benefit, I think, to overregulation during a time when we saw a lot of investment in financial services is that regulators could kind of be the countervailing force to investors and to founders and to banks that were rushing into banking as a service. And we could strike a maybe uneasy balance between those two forces. I don't know that we're going to have that balance over the next 4 years. So I think, number one, my caution to anyone building in financial services over the next 4 years is go easy and be cautious in what you build. Because I do think that a lesson we've learned is that if you can ignore some of the incentives in the market, or incentives maybe that you're even getting from your investors, and build things the right way, you are set up for a much more sustainable future. So something to keep in mind as we head into this Rumspringa where all the rules get tossed out the window for 4 years. Specifically, as we get into the different changes that we're likely to see, I'm not going to speculate too much because honestly, at this point, we still don't know. We've seen President-elect Trump announce some of the appointments that he's planning to make to his cabinet and to other government positions, but we haven't seen everything. In fact, we haven't seen a lot yet as it relates to financial services specifically. I would expect that there probably will be changes at the CFPB, probably fairly radical changes at the CFPB. The SEC, given its role in regulating crypto, seems likely for a pretty dramatic change. The OCC, where acting comptroller Michael Hsu was always the acting comptroller rather than the confirmed comptroller, I think we'll see some changes there. Possibly at the FDIC, given that Chair Grunberg had already faced some challenges to his leadership and had in fact said that he was planning to step down once new leadership could be announced. I think we could potentially see a change there. They did ask Fed Chair Jerome Powell at a press conference after the election if he would step down at the request of President Trump. He gave a one-word answer, no. So it does seem likely that the Fed is probably the one that will change the least, at least in the short term. But we will obviously see some changes on the regulatory side. In terms of the impact that's going to have on the financial services ecosystem and on some of the regulations. It's a little bit unclear to me. If I had to weigh in on some specifics, I would say that the proposed rule from the FDIC requiring daily reconciliation and kind of better ledgering of accounts for banking as a service that was floated in the wake of the Synapse rule or the Synapse situation, I think that's likely to stay. Even the Republican members of the FDIC seem generally supportive of it, maybe with a couple of tweaks. By contrast, staying with the FDIC, the rule on brokered deposits seems likely to be one that might get changed or reversed in a fairly substantial fashion. The Republican members of the FDIC had strong objections to the brokered deposits rule. And we've actually, in fact, already seen some impacts that rule has had on the financial services ecosystem, which I'll talk about in a little bit. So I could see that rule potentially changing in a fairly significant fashion. Open banking, which has kind of been my hobby horse over the last couple of years, that rule was finalized by the CFPB. If I had to guess, I would say that one actually probably doesn't change that much. There might be a push. We've seen certain areas like the banking trades kind of push back on open banking. And actually the Bank Policy Institute sued the CFPB over the open banking rule. So we might see changes more from a sort of judicial and legal perspective. But I actually think from a regulatory perspective, everyone is roughly on board with the idea that there should be some rule governing consumer permission data access to their own financial data. In fact, the Republican chair of the Senate Banking Committee, after the rule was finalized, released a statement saying that he was generally in support of the rule. So I think there's actually pretty strong bipartisan support for open banking, and I don't really expect that one to change that much. One comment that someone on Twitter made that I thought was interesting that I wanted to just weave into this discussion is that we might see, particularly with the CFPB, more time spent on enforcement within the regulatory perimeter and less time spent expanding the regulatory perimeter. I thought this was a really interesting comment. This person's observation was just that under, I'll just use the CFPB as an example. Under Director 𝗙𝗶, the CFPB has spent a lot of time building what you might consider to be sort of novel UDAP cases to look at unfair, deceptive acts and practices and trying to essentially find ways to bring more companies inside the regulatory perimeter who maybe ordinarily weren't considered to be heavily regulated by financial services regulators. This would be companies like Apple or even service providers to banks and credit unions like 𝗙𝗵𝗁 and what happened with ViStar Credit Union. So that I think is a really interesting observation. What that might mean if regulators are less focused on expanding the regulatory perimeter is they spend more time rigorously trying to enforce the rules inside the regulatory perimeter, which we did actually see quite a bit of that under the last Trump administration with the CFPB. It's not like they didn't bring enforcement actions. In fact, they brought a lot of them. They were just more sort of narrowly focused in areas where regulators have traditionally spent their time. So it'll be interesting to see, I guess, the balance between expanding the regulatory perimeter versus enforcement within the regulatory perimeter versus just more lax enforcement of all players within the financial services ecosystem. So somewhere there'll be a balance struck between all of those things. And again, it very much depends on the specific leadership that's put in place at these different agencies. Last couple of questions I want to ask before I move on from politics on the Fintech Takes podcast. The first is actually an effect that I think we might see on the market and on fintech companies' sort of interest in joining the public market, which is IPOs. We've seen the IPO window essentially slam shut over the last couple of years as interest rates have gone up and as public market investors have sort of telegraphed to aspiring late-stage fintech companies, we're not going to be very nice to you if you join the public markets. You're not going to have a really great time in the public markets. We're not going to value you as a software company. We're going to value you as a bank. Or if we do value you as a software company, you're not going to get the insane multiples that software companies used to get back in the good days. You're going to get more realistic valuations based on what we think your future potential actually is. If we see this sort of just general surge in enthusiasm in the market brought on by sort of a Trump era focus on deregulation, I think that could correlate into better sort of stock market performance for fintech companies, which might cause more late-stage fintech companies, and we all know the names of these guys, Stripe, Klarna, Plaid. We might see these companies express more of an immediate interest in jumping into the public markets and essentially sort of striking while the iron is hot. In fact, we did see just recently that Klarna announced they were going to be going public in the US via an IPO. And so we are already seeing the IPO window crack open. I think Trump's win could push that window much further open, at least over the next couple of years. And then finally, I also think that it's very possible that we will see banks kind of quietly back away from some of the initiatives that they had maybe reluctantly embraced under the Biden administration. And so there are certain areas where regulators can't directly force banks to do anything, right? It's not something where they can prescriptively say, hey, you must do this, or statutory requirements or sort of approved formal regulations require you to do X, Y, and Z. However, regulators, lawmakers, public policy advocates, they have a lot of soft power. And under the Biden administration, they use their soft power to try to influence banks to do things that they might not want to do, but that those parties feel like banks should do or should take responsibility for. And banks, I think, will reluctantly move in that direction when they feel that they have to. However, in a Trump administration where that pressure sort of goes away or is lessened, I think you could see banks not loudly or in an explicit way, but kind of quietly back away from some of those initiatives. So the one I'm keeping my eye on is scams, where we've seen lawmakers like Elizabeth Warren, we've seen regulators like Director 𝗙𝗶ศ์at the CFPB, we've seen tons of consumer advocacy groups jump up and down on top of banks and say, look, you have to do more to protect consumers from scams, in which they're authorizing a payment through a payment app like Zelle, but they're being tricked into doing it. And even though technically under Reg E, they are the ones who are liable for those losses, not the bank because they authorized it. Come on, banks, you can do more to help consumers here. And banks have been quietly, under the surface, doing a lot of work to try to improve in these areas and to move the ball forward. I hope that those efforts will continue. And I expect at least certain parties to continue pushing forward there. I do worry a little bit that the urgency that banks felt, which was, I think, the result of a lot of public pressure heaped on them, might diminish a bit. And that might sort of lower the priority level for them to work on some of these initiatives. So I hope I'm wrong there. I fear that I might not be, and it's an area that I'm paying a lot of close attention to. So with that, I'm going to go ahead and jump to the next topic, which is Bank Regulatory Agency's RFI, request for information that they put out on bank fintech arrangements. So this was the FDIC, OCC, and Federal Reserve put out a list of questions essentially to the industry, asking them for input on how bank fintech partnerships, or what the RFI called arrangements, work, and what the various sort of opportunities and risks are around those arrangements. This, and I've written about it a few times in the newsletter, so forgive me if I'm double dipping here a little bit, but I think it's really interesting because this is an area where regulators have historically addressed this through what they call third-party risk management guidelines, which is the way that regulators essentially regulate how banks work with their own vendors and suppliers. So think about the way that a bank would work with a core system like FIS or with a cloud computing provider like an AWS. That traditionally is how that third-party risk management framework has been used. That third-party risk management framework, and to regulators' credit, they understand this and are adapting to this reality, that framework doesn't work well when it is applied to bank fintech partnerships, primarily because in a bank fintech arrangement, it's the fintech company, the third party, the supplier, that actually has all of the leverage in that negotiation. It's not the bank, right? Because especially when we're talking about community banks that are sort of rushing to serve all of these new fintech companies, the community banks want to work with the fintech companies more than the fintech companies need to work with those banks. And so traditionally in the banking as a service space, the dynamics of how those relationships have worked have sort of been the inverse of how traditional bank vendor relationships have worked. And that's been the root of a lot of the issues that we've seen in banking as a service and in bank fintech partnerships over the last 5 years. So regulators are working on ways to try to figure out how do these relationships work? How should they be treated differently? What are the novel risks that they pose? How should we think about regulating these activities differently? And if you go through all the responses, and I think there were like 35 to 40 responses last I looked that were submitted, at least by the time that the comments were supposed to be submitted, there were a few themes. And I wrote about these in my newsletter, but I just want to recap them briefly because I think they're very useful to think about. The first one is that there's actually a pretty big schism between big banks and small banks that's developing. And I suppose that that schism has developed largely because of the Durbin Amendment and the ability for financial institutions under $10 billion in assets to still have uncapped debit interchange and be able to sort of have that revenue stream available to them. That's been a big reason why fintech companies have worked with small community banks. And I would say that big banks generally in their comments were pretty mad about that sort of loophole being exploited by fintech companies. The way you can sort of tell what big banks worry about is where they focus their ire in these sort of comments. And you could really tell that big banks don't really view community banks as a threat, really in any way, shape, or form, but they do really view fintech companies as a threat. So, specifically, one of the letters that was submitted was from PNC, which was interesting actually, because PNC doesn't really do a whole lot of fintech or banking as a service stuff. So it kind of felt to me like they were weighing in more to express their point of view than really to actually defend something that they had a stake in. To use legal language, it didn't really seem like they had standing in this case, but they decided to sort of weigh in anyway with an amicus brief. And their amicus brief essentially said that specifically deposit taking is a function that should only be the province of regulated banks. And in fact, legally, it is only allowed to be done by regulated banks. And as such, if fintech companies are going to do deposit taking, they shouldn't be doing it through a bank partnership. They should be doing it as a directly supervised financial services entity. And that brings us to the second sort of general point that came up a lot, and not just from big banks, but from small banks too, which was there was a request for regulators to more directly supervise fintech companies. And 𝗙𝗵𝗁𝗁 and Jason 𝗙𝗵𝗁 and Jason Henricks and all my bank nerd friends were very happy to see that the Bank Service Company Act, which is this obscure little law from the 1960s, is being mentioned in all of these comment letters as a mechanism that regulators could use to directly supervise fintech companies. Now, I won't get into the exact mechanics of how that works under the Bank Service Company Act. It is actually very complicated. There's actually also a lot of uncertainty as to how exactly it would work. The Bank Service Company Act has not been used super consistently over the years, but our influence campaign to try to get the Bank Service Company Act on people's radar clearly has worked. And banks were essentially begging regulators in their comment letters to directly supervise these fintech companies. Now, the flip side to this, and it's something that I think is really important to mention, is that regulators, while they want to see a lot of these risks reined in, and they want to see fintech companies not cause the type of damage that we're seeing to end fintech programs and to end customers realistically, which we've seen in the Synapse bankruptcy, they don't really want to, nor do they think they're able to functionally oversee and supervise all of these fintech companies. It's important to remember in the US, we have a lot of fintech companies. We have tens of thousands of fintech companies. And regulators just don't have the manpower, quite frankly, to be able to directly supervise all of these companies. And so there's this really interesting split where regulators are sort of asking banks, hey, how can we make this safer? And banks are saying, well, you could regulate fintech companies directly, and here's the legal avenues that you have to do that. And regulators say, we actually think it might work better if we come up with these frameworks and these mechanisms, and we actually outsource a lot of that supervision work back to the banks. And the banks say, well, we don't really want that responsibility. So it's kind of going back and forth a bit as to who's going to be responsible for more closely regulating fintech companies, but there is a sense that someone is going to have to do it because the status quo of fintech companies being loosely regulated, unregulated, regulated at a state level, but not at a federal level, that's not working very well. And so we need to do something a little bit different. There's also an emerging discussion that's very related to that around standard setting. And I think you might have heard me and 𝗙𝗵𝗁𝗀 and others rant about this in the podcast before, so I won't revisit that rant too much. But I will say that in the comment letters, there was a lot of commentary around the idea of standard setting organizations that could exist within the fintech ecosystem, where essentially fintech companies sort of jointly hold themselves to a higher set of standards, which would make it easier for banks and regulators to oversee them, to work with them, to be able to sort of sort out the good ones from the bad ones. I think the analogy that was most commonly used was like a SOC 2 security certification, but more around sort of fintech and sort of business and operational readiness and compliance. And there are some emerging efforts to try to make this happen. The Coalition for Financial Ecosystem Standards, or CFES, is one of them. There have been a couple other ones that have also sort of cropped up recently. I'm trying not to judge those efforts too harshly because they are in the very, very early stages. All I will say is that there is a lot of skepticism, even among commenters in the RFI who were promoting the idea of standards, a lot of skepticism about if standards will actually solve any problems. And in particular, there was a feeling that if banks weren't on board with that standard setting, and if regulators weren't willing to give some at least sort of unofficial blessing to that standard setting effort, it wouldn't really go anywhere. And so while fintech companies are starting to organize themselves to make this happen, the real progress that we need to make is getting others in the ecosystem outside of fintech to agree that this approach works and that the way it's being done is going to be effective. So too early to say exactly how that's going to work. I suppose we will have to just watch and see. I get a lot of questions about what you should look for when choosing a fintech partner bank. And at the top of that list are security, compliance, and operational resilience. As you know, I'm a huge advocate of building and scaling products responsibly. Nothing grinds my gears more than when companies move fast and break things. With Newline by Fifth Third, you don't have to sacrifice anything. You get the innovation of a modern developer platform with the stability and compliance competency of a leading bank. With an API-first platform, Newline enables enterprises to launch and scale payment, card, and deposit products directly through Fifth Third Bank. No annoying or expensive middleware layers to go through, just a secure and direct relationship with Fifth Third Bank. Find out more about Newline by visiting newline53.com. The last thing that I just wanted to mention, because it actually dovetails into the next story I wanted to talk about, is intermediate platforms. And this is a term that's used in the RFI. You probably are more familiar with this being called middleware platforms or banking as a service middleware. So this is companies like Unit, Synapse, obviously, was a sort of infamous middleware company, Treasury Prime, Synctera. There's lots of examples of these middleware companies, and they all have slightly different models, but the basic idea is that they sit in between banks and end programs and essentially help the two work together. And there's a lot of different levels on which they help banks and non-bank programs work together. There's a technical level, there's a legal level, there's a marketing level, there's an infrastructure level, there's an operational level. And essentially what we saw with the meltdown of Synapse was the sort of worst case version of what happens when there's that middle layer that obfuscates the direct oversight that should exist between banks and the fintech programs that they're working with. So, as you might imagine, in the wake of Synapse, pretty much everyone threw these intermediate platforms under the bus. Multiple banks commented that the best way to do bank fintech arrangements is directly and to not have an intermediate platform. Lots of fintech programs, including Mercury, hilariously, which had been using Synapse before, basically sort of disowned that model and said they had moved on from it and that essentially everything bad that happened was Synapse's fault, which is actually not true, but we'll leave that for another rant. And essentially they all threw these intermediate platforms under the bus. Now, there were a couple intermediate platforms like Treasury Prime and like a unit that did submit their own comments, and they very gently and very artfully tried to sort of argue for why their continued existence is important. And I do think to a degree, we need some type of like middleware layer to exist here. Banks and fintech companies, particularly community banks, have a really hard time working together just on a technology layer to set aside anything else. And so even if we don't see the same type of sort of all-in-one solution that we saw in the zero interest rate environment days of fintech, I think we will see some version of this idea continue to persist into the future. But everyone, including and especially regulators, and they're going to feel this way even more after they read all the comments, are much more skeptical of intermediate platforms than they used to be. So I want to jump to another story, which is actually highly related to it, which is Marqeta. So you might have noticed, and I wrote about this a little bit in my newsletter, so I won't go too deeply into this, but Marqeta, after it reported its Q3 earnings, its stock just got hammered by like, I think 30% drop maybe the day after trading. And whenever a fintech stock goes down by that much, I always try to dig in and kind of find out what happened. So I went and read the earnings call transcript, and it turns out the reason for that sell-off was that Marqeta had planned to get 15 new programs. And again, Marqeta, for those who don't know, is an issuer processor that essentially helps brands or other companies launch card programs, debit, prepaid, credit. And they had 15 programs that were going to go into production in Q3. Of those, only 5 went into production. Of the remaining 10, 9 are supposedly going to slip to Q4, and then 1 is slipping to Q1 of 2025. So in one sense, this was kind of a strange overreaction by the public markets. And I've always said that the stock market is kind of dumb in the way that it behaves oftentimes, particularly when you look at it in a short-term lens. There's nothing really material about Marqeta's business that's changing. They haven't had some large client defect. In fact, they brought Block back, which is their largest customer. They're still talking about having a huge demand for their services. It's just a temporary delay, essentially, in their ability to get new platforms into production, which is going to push back their ability to recognize and grow new revenue streams. What's interesting is the reason for the delay, and this is what's relevant to our discussion. The reason for the delay is essentially what we were just talking about, which is the increased regulatory scrutiny on bank, non-bank partnerships and the impact that that's having on the ability for banks to take on new partners. So essentially, Marqeta's explanation for why all of these programs slipped out of Q3 is because banks are being much more careful and much slower in how they onboard and get these new programs into production. And that has required Marqeta to essentially revamp a lot of its internal processes. They've developed some new strategies for how to help banks more quickly onboard new partners. They've adapted to some of the new requirements that banks are putting in place to manage this increased regulatory risk. Marqeta, it sounds like, is also adding a few new bank partners that they can work with so that they're a little less constrained on the bank partners that they have. So they're adapting to that, but that scrutiny is essentially what's slowed down their ability to get into production. Now, again, I think generally the stock market is kind of dumb to have overreacted to this. I don't think this tells us really anything material about Marqeta's prospects as a business. However, there was one little note tucked into the earnings call, which didn't get a lot of attention, because again, I think the stock market is stupid. But to me, as a fintech analyst who doesn't really care about Marqeta's stock price, but cares about the sort of larger dynamics that are happening in the space, I thought it was really interesting. Marqeta also shared that there were a couple of larger programs that are already in production. So these are their large customers that are already in production, where those programs are taking some of the functions, some of the program management functions that Marqeta is currently doing on their behalf. They're taking them in-house and they're doing them themselves. I thought that was really, really interesting. And it ties back to what I was saying about those intermediate platforms and how there's sort of increased scrutiny on them. One of the interesting areas of overlap between these banks and these fintech programs is that in addition to sort of needing to manage the risk associated with a bank working with a non-bank program, there's also this set of just like operational responsibilities that someone has to do, right? That sits sort of in between the bank and the end program. Disputes are a good example, right? If you offer a debit card, then you are required under Reg E to have a process for handling customer disputes. If they dispute a transaction or if they have some challenge with their account, there's a whole sort of regulated process for how you need to deal with those. Someone has to do that. Now, if it's a tiny community bank, they might not really have the staff or the ability to do that themselves if they've scaled up and have a bunch of these different fintech programs. By contrast, you also might see non-bank programs not also really want to take on that dispute management function because it's just not something that they want to do or have the staffing or the resourcing to do. So a lot of times, some of those program management things, the necessary operational work to manage these programs, are taken on by these middleware providers, whether it's someone like a Unit or a Synapse, or in the case of card issuing, someone like a Marqeta. Now, what's interesting is while the deposit form of this came under a lot of scrutiny with Synapse, and that's where there's been a lot of regulatory pushback, I hadn't heard of as much regulatory pushback in the card issuing space, because card issuing is a much older version of banking as a service in a lot of ways. It's existed for a long time, and it hasn't had the same regulatory scrutiny, partially because MasterCard and Visa also exist in this ecosystem, and they sort of play the role of a quasi-regulator where they sit over the top of this and have a lot of rules and a lot of monitoring, and they make sure everyone is doing the right stuff. So we haven't seen as much nervousness around program management done by these intermediate platforms in card issuing historically. However, what Marqeta's note in their earnings call might indicate is that we are maybe starting to feel the effects of that regulatory scrutiny seeping into the card issuing space. And if that's the case, that could be an interesting challenge for issuer processors like Marqeta, Lithic, Galileo, I2C, because those companies can definitely still exist without providing all of those program management capabilities, but a lot of their margin is built into providing those program management capabilities and not just being the sort of technical infrastructure that this runs through. And if that changes, or there's an incentive for larger programs to take on this work themselves, that will adjust the mix of how these different jobs to be done are done in the future. And I think that's pretty interesting. Final story, and then I promise I will let you all go from my solo podcast. And again, I would love some feedback from all of you on if this is a format you like, if it's a format you hated. Totally fine either way. I just wanted to talk briefly about something I haven't gotten a chance to write about in the newsletter, which is the FDIC and a new report that they released. They do it on an annual basis, and it's called the Report on Unbanked and Underbanked Households. And so essentially, they do a survey where they look at U.S. households and how they use financial products, and they specifically try to measure the rate of unbanked households, meaning those that don't have a checking account, and the rate of underbanked households, which is to say those that have a checking account but that use predominantly non-traditional financial products that sit sort of outside of the traditional regulatory perimeter. And then the mainstream financial services consumers that use traditional products, and essentially sort of measuring those three groups against each other. And I thought I would just quickly recap the results of the latest survey, which covers 2023. So first of all, just to give some high-level statistics, in 2023, 4% of U.S. households, which equates to about 5.6 million households, were unbanked, meaning that they did not have a checking account at a bank or credit union. The good news with that statistic, that 4%, is that it is half of what it was in 2011. So if you go back to 2011, the rate of underbanked households in the US was about 8%. Now it's down to about 4%. So while 4% is still too high, and that 4% is predominantly made up, by the way, of Black and Latino and disabled households and consumers that we really need to get into the sort of mainstream financial services ecosystem. So we still have a lot of work to do. We are making progress. And I do think that that number falling between 2011 and now is probably in large part a response to fintech scooping up a lot of these customers. And so I think that is evidence of really good progress that we're making. Interestingly, if you were to dig into that 4% of households who are unbanked, what the FDIC found is that 66%, so about 2/3, use cash to manage their finances. So when you think about who the unbanked really are, what do they do? How do those households work? Predominantly, they use cash, right? And so imagine someone, working at a construction yard, and the construction foreman pays them with cash every month. They pay all of their bills with cash. They might, from a budgeting perspective, use the envelope method where they literally have paper envelopes with cash for every budget category. They don't have a bank account. They just operate in cash. That is about 2/3 of the unbanked population in the US. The remaining third, and I'm guessing this is the population that's probably been growing relative to the other one, is customers that use non-traditional financial products that are not bank accounts, checking accounts offered by banks and credit unions in order to manage their finances. So this is prepaid cards, which is a historically very popular choice for unbanked and underbanked consumers, as well as more digital tools that can operate in a similar fashion. So think about PayPal, Venmo, Cash App, these sort of quasi bank accounts where you don't necessarily need to have a direct deposit. There can be multiple ways to add money to these accounts, but you are essentially not keeping money in an FDIC insured bank account. You are keeping it in some type of digital payment app that allows you to transact. So I would say that, the PayPals and prepaid cards and those providers are definitely eating into cash, but cash is still dominant among unbanked households, which I personally thought was kind of fascinating. If you looked at underbanked households, so again, these are households where there is a checking account with a FDIC insured institution, a bank or a credit union, there are about 14% of these households in the US. Of all households in the US, about 14% are considered underbanked. And that's about 19 million households, roughly speaking. Again, these consumers have a checking account, but if you look at the mix of financial services products that they use, pretty much all the other products they use sort of sit outside the mainstream. So they use those prepaid cards, they use PayPal, they use Venmo, they use Cash App, they use non-traditional forms of lending like payday loans, cash advances, auto title loans, these types of sort of non-traditional products. So they are banked in the sense that they have a bank account, but they are considered underbanked in the sense that they are not taken advantage of or maybe don't have access to the full suite of financial services capabilities. Now, on that note, 15% of households in the US, according to the FDIC, lack access to mainstream credit. So this is what we would consider to be your classic sort of unscorable, thin file, no file population. That 15% is down from 20% in 2017. So again, while 15% is still too high, and we have a lot of work to do with credit builder products and with all number of other things, cash flow underwriting, to bring more people into the mainstream credit ecosystem, we have been chipping away at that between 2017 and 2023, which is great news. Now, interestingly, in the FDIC data, in the survey they did this year, they added 2 new questions asking about products that they've never asked about before, which is very, very exciting to me. Those 2 products are BNPL and crypto. And I want to talk briefly about each one because the findings on them, even though we don't have historic numbers because this is the first time they've asked about them, the numbers themselves are pretty interesting. So let's do BNPL first, really fast. With BNPL, what the FDIC found was that 4% of households in the US in 2023 used BNPL. And the FDIC defined BNPL in the classic pay in 4 variety. What they found was that more banked households used BNPL than underbanked, which might surprise you. Because a lot of times BNPL is framed as a tool to bring more people into the banking ecosystem. Well, maybe, maybe not, because more banked households use it than unbanked households. Usage of BNPL was higher for households with incomes between $30,000 and $75,000 a year than it was for incomes either lower than that, which probably indicates that those consumers are even further outside the mainstream than BNPL can reach, or incomes that were higher than that, where I think you see credit cards tend to be used more frequently. They were also used more by households that have more volatile income streams, which I thought was fascinating because it speaks to the value proposition of BNPL as a essentially income smoothing mechanism, as well as, not surprisingly, younger consumers were much more likely to use BNPL. So that's who uses BNPL. Now, when it comes to this question of does BNPL increase access to the credit system, this is something I've written a lot about. The FDIC's take on this was that use of BNPL was actually higher among those who already had access to the mainstream credit ecosystem. However, it was also higher among those who use non-traditional forms of credit products like payday lending, auto title loans, some of those sort of more predatory forms of credit. This strikes me as a little bit of a contradiction. How can someone that has access to mainstream credit also then be a heavy user of some of those non-traditional or more predatory forms of credit like payday lending or auto title loans? I think the answer here is that BNPL is tapping into subprime and more desperate for credit customers. So if you think about the different populations, what the FDIC's data suggests is BNPL is not reaching customers who have thin file or no file credit invisibility problems, where they're not able to get access to credit because they have never had credit, they don't have a credit file. What the FDIC's data suggests, at least to me, is that BNPL is reaching into the population of consumers who have a traditional credit file, but maybe because of the quality of that credit file, have been forced to use more non-traditional or predatory forms of credit to make up the gap that they have in not being able to get the same type of mainstream credit they maybe used to get before. So I think that's really interesting in terms of, is BNPL reaching new to credit customers, which it certainly is to a degree, or is it reaching subprime consumers, which I think the FDIC's data would suggest that maybe it is. Now, related to that, two other quick facts about BNPL users from the FDIC. One is that 12% of households reported either a missed payment or a late payment in the last 12 months. And that was really interesting because it suggests to me that while 12% is high relative to sort of more mainstream forms of credit, it actually is still relatively low if you were to think about it in the terms I was just describing, where it's those subprime or credit damaged consumers that are using BNPL. So I think what that suggests, at least to me, is BNPL from a customer acquisition perspective is fishing in a pretty risky pond. And I think that's something that we've probably thought broadly for a while. But the structure of BNPL as a product, that pay in for structure where it's a low amount of money that you're loaning and it's a quick turnaround in terms of the repayment cycle, that structure prevents too much risk taking from happening because the loans just are too small and they turn off of your books so fast that there's not really an ability to have loss rates skyrocket out of control. So I find that to be strangely comforting, I guess, in the context of BNPL, even though they are working with, I think, higher risk consumers than they might want us to otherwise believe. The last fact on BNPL, which also speaks to the sort of nature of how it's used, is how often people or households use BNPL. And the FDIC's data was very consistent with what I've heard from others, which is most people use BNPL somewhere between 2 and 10 times a year. And that, I think, is a pretty average use of BNPL. You use it occasionally when it makes sense in the context of what you're doing. Now, a very small percentage, according to the FDIC, and this is what I've heard from others as well, use BNPL obsessively or excessively, like more than 10 times a year, more than 15 times a year, more than 20 times a year. Those sort of habitual BNPL users, that's where a lot of the risk is concentrated. And it's not just credit risk. That's where like loan stacking and risk of fraud and risk of a consumer sort of intelligently playing the different BNPL providers off each other, since they don't really share data with each other right now. That's where all that risk sits. And I think one of the reasons that BNPL companies have been reluctant to provide data to the credit bureaus or to share data outside of their own walls really hinges on the fact that while they know that population exists, it's pretty small. And the FDIC's data actually confirms that. All right, I want to wrap up with crypto because crypto, as always, is the most sort of interesting, volatile, entertaining area to study in fintech. If you read my essay last week, you'll know that I am a little concerned about the crypto ecosystem going crazy over the next 4 years under President-elect Trump. So we'll have to see how that goes. But the FDIC gives us some good data on crypto usage in the US. And unsurprisingly, the narrative here is very different than the narrative that I think you would hear from someone like a Coinbase, who has a sort of vested interest in presenting crypto as a tool of the people and a way to lift people out of financially dire straits and empower them to live a better financial future. According to the FDIC, in 2023, 4.8% of households owned or used crypto. That is not very high. That's relatively similar to BNPL. It is significantly lower than a lot of the estimates that you see from the crypto industry, significantly lower. And a couple things about those users that I think you might find interesting. One is that usage or ownership of crypto was much higher for banked households at 5% than it was for underbanked households at 1.2%. So unbanked and underbanked households and consumers don't really own crypto in meaningful amounts. Banked consumers, those who have a full set of banking relationships, they're the ones that use crypto more. And if you dig into who those people are in more specificity, again, probably not that surprising. It's people who have higher incomes. So, for example, households that make $75,000 or more in annual income, 7.3% of those households own crypto or owned in 2023. Versus low income. So if you look at households with less than $15,000 in annual income, only 1% of those households own crypto. So pretty big delta between those two. Usage was also much more common among younger consumers, more educated consumers. And while the FDIC data didn't break this out by gender, I would have to assume much more common among men than women. Not surprisingly, of those who owned crypto, and they were asked about why they own it, what they use it for, the vast majority said they hold it as an investment, right? So crypto is, according to the FDIC, a mechanism for relatively wealthy, relatively educated, relatively young consumers to diversify their portfolio. And essentially, that's how crypto is being used. So while we are starting to see the use of stablecoins as a rail that's invisible to consumers starting to take off, while we are starting to see a resurgence in sort of retail interest in crypto that is, again, being pumped along by the new administration and hopes for a sort of deregulatory agenda in crypto, I think it's important to ground ourselves in the fact that consumers by and large don't really use crypto that much, and the usage is concentrated among consumers that are already doing fairly well, financially speaking. So with that, I'm going to go ahead and gavel myself off. That is actually a much longer podcast than I thought I was going to do. Not surprising, if you know me, I love to talk about fintech. I hope this was useful to you. I hope you have a great week, and we will return to regular Fintech Takes podcast programming soon. Thank you. Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.